Welcome back to the deep dive. We are opening up the source material today to really dissect one of the most critical decisions anyone makes, assessing the true value of a physical asset, specifically real estate.
Yeah, and we're going far beyond just the asking price here.
Absolutely.
We've got a really interesting stack of sources,
Hmm.
kind of melding classic financial theory, some architectural history, and, those hard-nosed investment tactics.
So, our mission today isn't just to summarize what drives value, it's more about equipping you, the listener, with that rigorous mindset, like a fundamental analyst.
Exactly. We want to help you cut through the, let's say, curb appeal, the emotional noise, and really calculate a property's intrinsic worth and back it up with robust systems, clear criteria.
Right. We're pulling together concepts that shaped how Wall Street looks at stocks, but applying them straight to brick and mortar. We'll get into the actual nuts and bolts of buildings and then pull out some advanced strategies for after you buy things like leverage, taxes.
The whole picture, it's about building a firm foundation of value, both, conceptually and literally.
Okay, so let's start with that fundamental challenge in all investing. Knowing that the price you pay today, well, it's rarely the same thing as the value you actually get.
Spot on. And our sources frame this really well by outlining these two major, often opposing schools of thought in market analysis. You see this split whenever you analyze any asset you can trade.
Whether it's Amazon stock or a house down the street.
Precisely. So first up, you have the chartists. These are the folks doing technical analysis. They basically operate from the belief that the market is overwhelmingly psychological. Maybe, say, 90% driven by emotion, by noise.
They sometimes get called the castle in the air school, right?
That's the one. Their goal isn't really to figure out what something should be worth. It's more about anticipating what the crowd, the other players, will pay for it next.
So they're looking at past price movements, patterns on charts.
Yeah, trying to read the psychological momentum, hoping to sell that castle to a greater fool tomorrow for more than they paid today.
Mm. And this focus just on price momentum and trading volume. How scientific is it, really?
Well, that's the critique. Academics often dismiss it as being kind of like astrology and every bit as scientific. Now, traders can make money this way, definitely.
Sure.
But the long-term academic view is that consistently beating a simple buy and hold strategy,
Hmm.
it's really difficult unless you're willing to take on significantly greater risk.
Okay, so that brings us to the other side, the counterpoint. The fundamental analysts.
Right. And they hold the diametrically opposed view. They believe the market is predominantly logical, maybe 90% driven by facts you can actually discern.
They don't care about the squiggles on a chart, then.
Not really, no. What they're after is the security's proper value, what they call the firm foundation of value. This intrinsic worth, it's determined by tangible, measurable factors.
So in corporate finance, that means things like assets, expected earnings growth, dividends, interest rates.
Exactly. And for real estate, this translates pretty directly. You're looking at net operating income, or NOI, maybe anticipated rent growth, and that crucial metric, the capitalization rate, the cap rate.
Ah, the cap rate. So, like the PE ratio for stocks, the cap rate is key for property analysts.
That's a great analogy. They look at the net operating income. That's the income left after you pay operating expenses, but before debt payments, and they divide it by the property price.
And if their calculated value based on the cap rate they think is right for that market is higher than the current price.
Then they'd advise a buy. They believe the market will eventually, swing back and recognize that real worth, it's about the long game, based on logic.
Okay, but relying on logic doesn't mean there's no risk, right? We have to define risk properly here.
Absolutely critical.
Yeah.
Risk isn't just the simple fear of losing money. The formal definition is the chance that expected security returns will not materialize, and in particular, that the securities you hold will fall in price.
So it's about the uncertainty of the outcome.
Exactly. Understanding that potential spread of returns is essential, especially when we talk about trying to consistently beat the market. Academic theory is pretty clear. The only predictable way to systematically get higher returns is usually by taking on greater risk.
And maybe the biggest risk factor that messes with fundamental analysis is crowd psychology, the herd mentality.
Oh, absolutely. We see this over and over again in market cycles. The sources point to the internet bubble as a classic example. People were buying assets for no other reason than that prices were rising.
It becomes this powerful feedback loop, doesn't it? Excitement breeds more excitement.
It really does. People get swept up in the prospect of huge, quick gains. That excitement spreads like wildfire. FOMO, The fear of missing out takes over.
Yeah, and that famous quote from economist Charles Kindleberger really hits home here. There is nothing so disturbing to one's well-being and judgment as to see a friend get rich.
It's so true. You see your neighbors flipping houses for massive profits in just a few months, and suddenly your careful cap rate analysis feels, well, irrelevant. It tempts you to just jump in.
So discipline becomes paramount.
It really is. But this fear of loss and the sort of analysis paralysis that comes with it, that's something the rich dad philosophy tackles directly. Most people are just terrified of losing money.
And that fear stops them from acting.
Right. The wealthy approach, or at least the mindset described, is different. They see failure or loss not as the end, but as a learning opportunity, a chance to turn that loss into a future win by figuring out what went wrong.
It's a kind of mental resilience.
Exactly. And it gives sophisticated investors the courage to act decisively when others are panicking or backing away, maybe when the market dips or when a deal looks tough on the surface.
Okay, this mental fortitude seems to lead right into a really practical concept from the tactical sources, establishing the home run number.
Yes. This is your non-emotional preset price point that makes a specific property worth buying for you.
It's like the ultimate filter, isn't it?
Totally. You have to set your criteria first. The right neighborhood, the cash flow you need, the condition you'll accept. If a deal, no matter how good the agent makes it sound, doesn't hit that home run number.
You just dump it. Move on.
Precisely. That predetermined number anchors you. It stops the herd mentality from dragging you off course.
And this need for rigor doesn't stop at the price, does it?
Not at all. Once you find a deal that hits the number and you decide to move forward, the sources really hammer this point. Meticulous documentation is crucial.
Never assume anything about financing, for instance.
Never. Especially in competitive markets, get everything in writing, every term, every condition, every agreed-upon repair. Make it legally binding. Your brilliant analysis is worthless if your execution gets sloppy.
Okay, so the financial foundations are solid. You've got your home run number locked in. Now the focus shifts completely to the physical asset itself. We're moving from cap rates to capital expenditures.
Exactly. Understanding the cost of maintenance and, crucially, the potential for adding value.
Right. This isn't just a quick walkthrough admiring the paint job.
No, it's about assessing the cost of improvement. And sometimes the true cost involves subtle things, like differences in contractor pricing that, well, every investor really needs to know about.
Like the point about electricians. Our sources say they tend to be pricier than many other trades. Why is that?
Yeah, it's not arbitrary. It basically boils down to their risk profile. Electricians usually need more formal education, suffer licensing exams. They have to carry way more liability insurance.
And the work itself is higher risk.
Absolutely. Bad electrical work can cause fires, serious safety hazards. So it's one area where trying to cut corners, maybe using an unlicensed handyman, is just strongly advised against.
Makes sense. And when you're doing a major rehab, there are code requirements that automatically become cost factors, right? Like GFCI outlets.
Oh yeah, that's a big one. If you pull permits for significant electrical work, the building inspector is almost certainly going to require you to upgrade outlets in kitchens, bathrooms, outdoors, garages, anywhere near water, basically, to GFCI, ground fault circuit interrupter outlets.
And those are the ones that trip automatically if there's an issue.
That's right. They detect tiny differences in current flow and shut off power instantly to prevent shocks. You absolutely have to budget for those upgrades. They're non-negotiable for safety and getting your permit signed off.
Okay, good to know. Similarly, there are simple choices during renovation that can save huge headaches later, like with replacing interior doors.
Yes, the recommendation here is really specific. Always try to spring for pre-hung doors.
So that's the door already mounted in its frame.
Exactly. Hinges installed, often the latch mechanism too. Now, they might cost a little bit more upfront than just buying the door slab itself.
But they save time and hassle later.
Massively. Saves your carpenter significant time on site. And more importantly, it prevents those long-term annoying issues, doors that don't hang plumb, that stick, that won't latch properly. Drives tenants nuts.
Ah, so it's that classic spend a bit more now to save a lot more later situation.
Precisely. Spend $100 more on the pre-hung unit, save $500 in labor and future callbacks.
This kind of tactical knowledge feeds right into value-add strategies, doesn't it? Especially the BRR, method buy, rehab, rent, refinance, repeat.
Absolutely. The whole game there is maximizing your after-repair value, your ARV, through really targeted, high-leverage spending.
And the sources give a great example of this. adding square footage by converting unused space.
Yeah, it's a fantastic strategy, especially when the property already has some of the basics in place.
Hmm.
Think about enclosing a screened porch or maybe converting a small attached shed or storage area.
So places that often already have a concrete pad, maybe a basic roof overhang, and they're close to existing electrical or plumbing lines.
Exactly. Because those foundational elements are there, your cost to actually finish that space around HVAC, insulate, put up drywall, basic finishes can be relatively low, maybe $5,000 to $10,000 depending on the specifics.
But the impact on the ARV can be much bigger.
Hugely disproportionate sometimes. That small investment can boost the property's appraised value by $10,000, $20,000, even up to $40,000 in some cases.
Wow. That's a return on that specific expenditure of 200, 300, 400%.
And that's the engine that drives the refinance and repeat parts of BRRRR. You pull that newly created equity back out to buy the next property.
Okay, so beyond the cost of improvements, a really sharp investor needs to be able to read the building itself. Architectural style isn't just about looks, is it?
Not at all. It's like a code. It tells you about the age, the materials used, and importantly, the kind of maintenance burden you can expect.
Give us an example. What clues should we look for?
Okay, well, consider windows historically. In early New England Georgian houses, glass was imported, really expensive. So windows had these tiny panes, maybe 6 by 8 inches, 8 by 10 at the largest set in very thick wooden dividers called muntins, sometimes an inch thick.
So if you see that today, it screams potentially high replacement costs, tricky glazing.
You got it. Now, contrast that with shutters. Georgian homes generally didn't have those louvered blinds or shutters we see everywhere. Those came in later, maybe late 18th century.
So if you see that typical stark white house with green or black louvered blinds,
You're likely looking at the Greek Revival style, which really took off after the 1820s. Just knowing that helps you instantly date the core structure and anticipate its maintenance profile.
interesting. What about materials? Any clues there?
Yeah, the sources mention Palladio.
Yeah.
When he designed these grand Italian villas, he often used plain stucco or plaster on the big wall surfaces, painted in warm, earthy tones.
Which sounds fancy, but
But they were actually inexpensive, common materials. He used them to create this subtle backdrop that made the really rich, expensive details, the carvings, the trim pop even more. It shows that mixing high and low-cost materials for visual impact is an age-old strategy.
smart. And understanding the history helps assess maintenance needs too, right? Like with the stick style.
Absolutely. That style, popular in the mid-1800s thanks to guys like Gervais Wheeler, really emphasized showing off the building structure externally. Lots of exposed beams and decorative woodwork.
So if you own a stick style house,
You know that keeping those exposed elements protected from the weather, preventing rot, requires constant religious maintenance. It's built into the style.
okay, finally, whether you're flipping a house or just trying to get top dollar for a rental, presentation is key. The art of staging.
Crucial. And it's important to understand the difference between staging and decorating.
They're opposites, aren't they?
In a way, yes. Decorating is all about enhancing the homeowner's specific individual taste. Staging is about removing that personality. You want to cater to the broadest possible pool of likely buyers. Create a neutral, aspirational feel.
So how do you achieve that? The sources mention a critical walkthrough.
Yes, this is vital. The homeowner needs to ask an observant outsider, ideally someone from the same generation as the target buyers, to tour the house and be brutally honest.
And the owner's job during this.
Is to clam up. Resist the urge to explain or defend anything. You want this outsider to find the flaws you've become blind to. Open that sticking door, turn on the faucet with low pressure, flush the toilet that runs. Find the red flags.
Because a buyer will spot those immediately.
Instantly. And there's staging tricks designers use, especially for photos. Making rooms look bigger is a big one.
How do they do that?
Clearing floor space is key. Sometimes they even remove all the rugs just for the photos. And pay attention to furniture depth. Yeah. Designers might swap out standard 24-inch deep bookcases for shallower ones, maybe 12 or 16 inches deep. Doesn't sound like much.
But it makes the room look bigger visually.
Massively. Especially through a camera lens. It just opens up the space.
Smart, and don't ignore the small stuff, right? Like minor cracks.
Or never. Little cracks in plaster or wood are common, especially in older homes, and usually harmless structurally. But a buyer sees a crack.
And they immediately think foundation problems, $10,000 repair.
Exactly. Even if it's not true. So the advice is clear. Even though this crack is probably harmless, it should be repaired with spackle and a paint touch-up. First impressions and avoiding the assumption of big problems are everything.
Okay, we've gone from financial theory to the physical reality. Once you actually secure the property, The game shifts again, doesn't it? Success becomes all about execution.
That's right. Mastering the operational side. Leverage, taxes, and managing people.
Let's start with leverage. The sources call it the true financial superpower of real estate.
It really is. Think about it. Unlike starting a business where getting a big loan is tough and risky, real estate lets the average Joe, as the source puts it, borrow huge sums, maybe $400,000 or more, from strangers, often at pretty good rates.
Because the loan is secured by the property itself.
Exactly. That tangible asset backing the loan makes all the difference. It's what drastically accelerates wealth creation. But to really grasp its power, you need to look beyond just return on investment, ROI.
You need to focus on return on equity, ROE.
Precisely. ROI looks at your return based on your initial cash down payment. But ROE is arguably a truer measure of how your investment is doing over time.
How is ROE calculated again?
You take the amount the property makes each year, cash flow plus appreciation, usually, and divide it by the amount of equity you currently have tied up in the property, not just your original down payment.
So as you pay down the loan principal, your equity grows, and ROE shows how hard that equity is working.
Exactly. It gives you a dynamic picture. Let's use the example from the sources to make it concrete. Imagine a $100,000 property bought with $10,000 down.
Okay, 10% down.
Now, let's say the property appreciates by just 4% in the first year. That's a $4,000 increase in value.
Right.
Since you only put in $10,000 of your own cash, that $4,000 gain represents a 40% return on your initial equity in that year, not 4%.
Wow. Okay, even factoring in loan interest, the principal is clear.
Yeah, even after interest, maybe that 4% appreciation still yields a 20% or higher return on your original cash investment, purely because of leverage. You're making money on borrowed money. That's the engine for growing a portfolio.
Okay, but to actually keep that accelerated wealth, you absolutely have to understand the tax strategy toolkit.
Oh, crucial. And the first most fundamental tool here is depreciation.
Right. The idea that buildings wear out over time.
Exactly. The IRS recognizes that structures and improvements, not the land itself, that doesn't depreciate, lose value over time. So tax law lets real estate owners deduct a portion of the structure's cost each year.
Usually over 27.5 years for residential rentals.
That's the standard. And the magic here is that depreciation is a non-cash deduction. You didn't actually spend that money in that year.
But you still get to subtract it from your income for tax purposes.
Correct. This often leads to a situation where a property is cash flow positive, putting money in your pocket each month. But on paper, for tax purposes, it shows a loss, which means your rental income might be partially or even fully tax sheltered.
That's powerful. What's the next tool, the 1031 exchange?
The 1031, often called a like-kind exchange. This is absolutely essential for investors who want to grow their portfolio without getting hit by capital gains taxes every time they sell.
So it lets you defer taxes.
Yes, defer. You don't avoid them forever, but you postpone paying capital gains tax on the sale of an investment property if you follow specific rules to buy another like-kind investment property afterwards.
It's not a loophole, it's part of the tax code, but the rules are strict, right?
Extremely strict. The two big ones are timing. After you sell your first property, the relinquished one, you have just 45 days to formally identify, in writing, potential replacement properties.
Only 45 days, that's tight.
It is. And then you have a total of 180 days from the date you sold the first property to actually close on the purchase of the replacement property or properties.
And if you miss those deadlines,
the whole gain becomes taxable in the year you sold. No deferral. You also generally have to roll over all the proceeds from the sale into the new property. But if you do it right, you defer the tax bill until you eventually sell that final replacement property in a normal taxable sale years down the road.
Okay, very useful for scaling up. What about passive loss offsets? This sounds interesting, especially for people with regular jobs.
Yeah, this is a fascinating benefit. Let's say you own a rental property, and over several years, due to depreciation and maybe some initial negative cash flow, you accumulate passive losses on paper, say $50,000 worth.
But if your regular W-2 income is high, say over $150,000, you generally can't use those rental losses to offset your job income each year, right?
Correct. Those passive losses get suspended, carried forward year after year. But here's the kicker. When you eventually sell that rental property in a taxable transaction,
what happens to those accumulated losses?
You get to unleash them. In the year you sell the property, you can use that entire accumulated passive loss, that $50,000 in our example, to offset other income. That could be your W-2 salary, capital gains from stocks, whatever.
So if I make $250,000 at my job, and sell the rental, releasing $50,000 in suspended losses, I only pay income tax on $200,000 that year.
Exactly. It's a huge delayed tax benefit that helps full-time workers who invest in real estate. Stock market investors just don't get that same kind of mechanism.
Okay, mastering the finances is one thing, but then there's the operational side dealing with people, property managers, tenants.
Just as crucial, many investors use a professional property manager. Ideally, someone who only does management, not just a real estate agent doing it on the side.
Why is that distinction important?
A dedicated manager provides invaluable market intelligence. They're dealing with dozens, maybe hundreds of properties. They know exactly which neighborhoods are hot, what amenities tenants are demanding right now, how long units are sitting vacant, and precisely where rents are climbing fastest.
So you're leveraging their scale and data for your one property.
Exactly. But whether you manage yourself or hire it out, one thing is non-negotiable. Discipline with tenants, especially about late rent.
Ah, the late rent dilemma. The sources say if you allow late payments, you're basically training the tenant that it's okay.
That's the argument. Even if you feel sympathetic, being lenient unintentionally teaches the tenant that the lease agreement isn't really binding.
But hang on, isn't there a risk there? If you're super strict, immediately slapping on late fees, don't you risk alienating a good tenant, damaging the relationship?
It's a fair question, that balance. But the sources argue pretty strongly that being strict consistently and fairly enforcing the late fees right away is actually the best scenario for everyone in the long run.
How so?
Because if you're lenient, you might inadvertently teach the tenant to prioritize other bills, car payments, credit cards, ahead of your rent. That leads to chronic lateness, which becomes a massive headache for both you and the tenant eventually. Consistent enforcement leads to reliable tenants and reliable cash flow. Predictability benefits everyone.
Okay, that makes sense. Consistency builds expectations. Finally, let's loop back to the buying process negotiation tactics. The tit-for-tat strategy.
Simple, but really effective. The core idea is never give up a point in negotiation without asking for something in return.
So if the seller asks you to waive an inspection contingency,
You respond with something like, okay, if I agree to shorten the inspection period like you asked point X, would you be willing to cover the cost of the appraisal point Y, or maybe offer a credit for Z?
always asking for something back, what's the psychology behind that?
It's key. If you just concede easily without asking for anything in return, the seller might immediately get seller's remorse. They might think, wow, they agreed so quickly, I must have priced it too low.
Ah, so it keeps the negotiation balanced and prevents them from second-guessing the deal.
Exactly. Maintain that dynamic. For every ink you give, ask for something back, even if it's small. So we've covered a lot of ground, the financial formulas, assessing the physical structure, the operational systems. It's all crucial for successful real estate investing.
Right.
But if we zoom out and connect all these pieces, we see something important. The value and even the health of your investment. It's kind of fragile, isn't it? It's all built on this historical and regulatory foundation that often, well, dictates exclusivity.
Yeah, the sources brought up how distinct American land use rules are compared to the rest of the world. Zoning here seems intensely focused on separating uses.
Industrial here, commercial there.
And this almost sacred treatment of one specific housing type, the single-family home with its own private yard.
It's quite unique globally. And the historical perspective the sources provide is, frankly, startling. Early American urban planning didn't just prefer the single-family home. It actively framed the apartment building as, like, the intruder.
Words like thief and parasite were used against apartments.
Yeah, unbelievable today, but yes. The single-family home was positioned as the gracious host, the only truly legitimate form of housing, the only real citizen with a right to the city landscape.
And that philosophical split wasn't just talk, it got baked into law pretty quickly.
Absolutely. Once courts upheld this distinction between detached homes and apartments, cities jumped on residential zoning, things like mandating minimum lot sizes, setbacks, outright prohibiting multifamily construction in huge areas as a powerful legal tool.
A tool for social and class exclusion, essentially.
That's what the sources argue, yes. The suburbs became the domain of the middle and upper classes, reinforced by infrastructure like railroads and later the automobile, solidifying this pattern of outward migration and status seeking.
So this regulatory layer, which most homeowners probably don't think about day to day, it's kind of the unseen foundation supporting the value of their home.
It really is.
Yeah.
The exclusivity guaranteed by that low-density zoning is, in many ways, what underpins the value you calculated using your cap rate analysis back in step one.
Huh. But there's a tension there, isn't there? The pursuit of wealth, that financial logic, sometimes seems to undermine the very things that create value in the first place.
That's a powerful point. The sources mention the destruction of New York's original Pennsylvania station, this incredible architectural landmark,
Torn down for?
basically for real estate logic. The logic that says you maximize profit by maximizing density, even if it means demolishing the very building that made the area special and desirable. The potential profit from a new office tower trumped the building's foundational cultural value.
That idea that maximizing returns can lead to destroying the desirable environment itself, that really brings us to our final thought, doesn't it?
I think so. It's a provocative question for you, the listener. We've spent this whole time talking about how to maximize your wealth using financial models, leverage, smart renovations. But if the financial health of your investment ultimately rests on local zoning codes, tax laws, this regulatory foundation, what critical assumptions are you making about that foundation?
Assumptions about its stability, about the permanence of that exclusivity in your neighborhood.
Exactly. And what are the hidden long-term social and economic costs of maintaining that exclusivity? You're essentially placing a massive financial bet that the regulatory environment, the rules of the game, will stay constant.
So the crucial question to always keep in the back of your mind is, what happens if or when those foundational rules change? What happens when that exclusivity is no longer legally guaranteed? That's definitely something to think about.
That's your assignment for the road ahead. We'll see you next time on The Deep Dive.